All right, welcome everybody. Thank you so much for being here. It's a very I don't know what the right word is. I guess I should have come up with the right word. It's a very exciting, I think, presentation today. Not because this topic is particularly like sexy or something like that, but one, because generally, and general is the key word there, I do presentations on big picture topics like Medicare or Social Security or taxes, right? And we go through a ton of different aspects of whatever it is we're talking about. And we are going to do that today. But we decided to do this. This is the first time we've done a presentation specifically on qualified charitable distributions. And you're all here, so you probably have some awareness of what this is, right? If you didn't know what it was, and hey, if you're here and you're just like, hey, I just need to figure out what this is, then great. But most of you probably have a sense of what a QCD is. And that leads me to my first point. I'm letting everybody get logged in by giving you this preamble. But my first point is that we're going to cover some acronyms today. Qualified Charitable Distribution, QCD, Required Minimum Distribution, RMD, IRA for Individual Retirement Account. And I mean, I could, and I will do my best not to just throw acronyms at you. They exist for a reason. It makes it easier to talk about this stuff a little bit. But frankly, it's one of the biggest sins of the financial world, in my opinion, that they're so jargon and acronym heavy. I mean, I could sit up here and say, and this would be a real thing I could say, your QCD from your IRA to a 501c3 satisfies your RMD, right? That's how I could start this. And I guess I am, but kind of as a joke, right? I promise it will not be that dense to go through, or at least I will do my very best. And if at any point I've said something that you say, rewind that a little bit and say that again. What was that acronym you used, or what was that piece of jargon? Just let me know in the chat, please, or ask a question. And the Q&A line is open. I'm very happy to dive into questions, but we're gonna hit QCDs, qualified charitable distribution, from kind of all angles. One, what are they? Two, why are they important? Three, what can you do with them? I would say is the agenda. And again, for anyone who hasn't directly worked with me or interfaced with me before, my name is Anthony Gerbi, advisor and now actually CEO and president of Stein Financial Group. That was a transition we made in the last month, but the group is continuing just as it had before. We're very excited about the future. Just a couple of quick disclosures there, and then I will get started. So before even talking about what they are, or at least while talking about what they are, why do they matter? And the why is the reason why you may not have heard of these 10 years ago, even though they did exist. These have been around for a while. But in 2017, everything changed. So that's where we need to start. And actually, when we talk about QCDs, what we're really talking about are taxes. It's a way to potentially reduce your taxes. That's why they're important, if I were to sum it up. And basically, to figure out, there's two components to whether you should be doing QCDs, and maybe three, because the first component is whether you want to or not. QCDs, qualified charitable distributions, are distributions to a qualified charity. So it's money sent out to a charity. So as always, that's you get to decide how charitable you want to be. But the thing that changed in 2017 was the standard deduction on your taxes. Okay. So, one question for you or your tax preparer, if you don't do your taxes, is do you tend to itemize your deductions on your taxes, or do you take the standard deduction? And statistically, I'm going to say 9 out of every 10 of you on this call take the standard deduction. That's what the statistics say. So if you itemize, great, more power to you. You get to itemize your charitable donations just like you always used to. But in 2017, the standard deduction basically doubled. And for both individual and couple. So couple, if you're filed jointly, you get to combine your standard deductions, and then you combine a doubled amount, well, it doubles the total. So it became a high bar to clear. And let me explain that for just a second, because this is the most important concept as to why QCDs became more popular. When you do your taxes, or when somebody does your taxes for you, you get a choice. You can itemize all your deductions, and that's charitable donations, medical expenses, the interest on your mortgage now, and those deductions change every year. That's kind of how they incentivize different behaviors in the country. But you can add all those up, right? All your deductions and say, okay, that equals this number. And then you compare that number to the standard deduction. And standard deduction is exactly what it sounds like. Everybody gets it. You don't have to do anything to earn it. Okay, so everybody, me, you, file joint or single, doesn't matter. You get a standard amount of deduction. That's literally what it is. And so you want to you do take, hopefully, the one that is the higher number. You want a bigger deduction because what it's doing is it's reducing your taxable income. We want to reduce it, at least if we're trying to save money, to the smallest number we can within the rules, of course. But what happened was when the standard, so if your itemizations are here, let's say, and I'll avoid using real numbers for a second because I think that gets us into the weeds. So this was where your itemized deductions came at. And before 2017, maybe the standard deduction was here. So it's like, okay, well, I'm itemizing every year because that's a better deal for me. I want the bigger number. But then when the standard deduction doubled, well, now all of a sudden these itemizations don't even matter over here. And I'll give you my personal example. I haven't itemized my deductions since 2017, and not like I just don't do it. Although at this point I know going in that I'm not going to need to even save those receipts because I know I can't beat it. But most people can't beat the standard deduction, which means, so thank you for listening to my tax part of the conversation, which means if you do any donating to charity and you don't itemize your deductions, you are not getting any tax benefit for those donations. Let me say that again. If you donate to charity and you're writing a check, you're giving cash, and by the way, that doesn't mean it's bad to donate, of course. The primary thing is getting the money where you want it to go, right? But if you are donating and you're taking the standard deduction, you're not getting any tax benefit for those donations. QCDs, Qualified Charitable Distributions, are a way to take the standard deduction and get the benefit from your donations. So that's why they become so much more popular. Um, the at a glance rules, and this is where it's going to start getting a little more confusing than it should be, frankly, but you'll notice the very first bullet point here is that 70 and a half is the age at which you can start doing qualified charitable distributions. Now, not everybody on this call is going to be 70 years old yet, okay? And that's okay. This is still an important thing to know about, but you are not eligible to do this until you are 70 and a half. Now, if you remember, and if you do, kudos to you, extra points. The RMD age, required minimum distribution. By the way, what is an RMD? If you really want to dive into RMDs, we did an RMD event earlier this year. It's on our YouTube channel. You can watch the replay of it. But let me explain it really quickly. When you turn, as the rules are now, 73 years old, you have to start taking money out of a pre-tax retirement account, whether that's your old deferred comp, a 401k, or an IRA. And an IRA is an individual retirement account. So you have to start taking money out. Why can you? I'm tying this QCD concept to RMDs, the charitable to the required amount. Why am I tying those together? Because that's kind of how you use them. They play together. So why you should be thinking, or you might be thinking, why are the ages not the same? Why can I do a QCD at 70 and a half and I only have to take my RMD starting at age 73? And by the way, that's eventually going to go to 75, that RMD age. So why aren't those the same? And the answer is they used to be. What happened is the RMD age used to be 70 and a half. Some of you may remember that number is sticking. Yeah, wasn't there a weird half year thing? That used to be the age at which you had to start taking RMDs out, required minimum distributions. That changed a handful of years ago. They upped it to first 72 and now 73. So it decoupled the QCD age from the RMD age. So just a little bit of trivia, not that that really ultimately matters, although I'll get to why that's important to know the ages in a second. The other big point, well, there's lots of big points, but maybe the other biggest point is you cannot do, and this is just the way the rule is written, you cannot do a qualified charitable distribution from a work retirement account, whether that's deferred comp, which is a 457. The numbers are just the part of the tax code that created the account, basically, or a 403B or a 401k. So let me say that again. You cannot do a qualified charitable distribution from a 401k, 403b, 457 deferred comp. It has to be a traditional IRA. Okay, that's the only place that you can do this from. Now, all of those other types of accounts I just mentioned can be turned into an IRA, an individual retirement account. And doing that's called a rollover. It doesn't cost you anything in taxes to do it. And a lot of people like to do it anyway because there's other reasons to do a rollover. But if we're looking at taking advantage of the ability to do these charitable distributions, it's got to be from an IRA. So for some people, that's enough motivation to say, you know what? I think I should turn my work account into an IRA because now I have access to this. Okay? Funds must go directly to a qualified charity. Well, what's a qualified charity, Anthony? It's a 501c3. They have to be registered as a nonprofit. It does not have to be a religious organization, though it can be. It doesn't have to be a local organization, though it can be. Most of the nonprofits, whether they're hyper local, like in your neighborhood, or national, global, like the Red Cross, let's say, are going to be registered as 501c3s, which means they're a registered nonprofit. So it's really pretty diverse. I mean, no, you can't give it to your nephew and say, well, he's kind of a charity case. That doesn't count. They have to be registered as a nonprofit. And the word doing a lot of heavy lifting in that third bullet point there is directly. Okay? What that means is when you send the money out, we'll get into logistics a little bit later here, but when the money goes out, it doesn't go to you, you deposit it in the bank, and then you write a check. It goes directly to the organization, whether it's we mail the check for you, because this is something we can help you do, or we make out the check to the charity and then you can deliver it. That's fine. But the check is going to be made out to the charity from the start. There's no funny business where it's like, well, I'll deposit it and then I'll get around to, and then I get out of the taxes of it. That would be skirting the rules. That would not count as a qualified charitable distribution. And just for trivia, I mean, God bless if you get to this maximum. You can do this up to 111,000 per person per year. I'll say it, no one is even close to that generous that we work with, that they're giving away $100,000 a year, but you could. And there is technically a maximum, even though realistically nobody we work with anyway gets close to that. All right. Why is it valuable tax wise? I've kind of alluded to that a little bit, right? Okay, so your standard deduction versus itemizing, you're not getting any benefit for your charity at this point. Why does this give you a benefit that itemizing doesn't? The reason is when you are RMD age, required minimum distribution age, which right now is 73 again, you have to take out money from your retirement account, whether that's a work one or an IRA, right? And the reason you have to do that is so that the government can tax you on it, because that money in that account is pre-tax. Now, you may have some after tax, like a Roth IRA or a Roth deferred comp, and you don't have to take money out of those. So this is only for the pre-tax part. But the reason they make you take it out is so that you start getting taxed on it. You have to take out a chunk every year. And again, that's a whole, RMDs are their own topic. But the cool thing about QCDs, qualified charitable distributions, is they count towards your required amount every year. So let me put this in concrete terms. Let's say you have a $100,000 IRA pre-tax. The RMD from that, the year you turn 73, is going to be just about $4,000. It's a little bit less than that actually, but it's about 4,000, 4% to start off with. So you're going to have to take out 4,000 whether you want to or not. You don't have a choice. You're being forced to take that money out. If you take the money out and spend it or reinvest it or do anything with it, normally, you have to pay taxes on that 4,000 from the $100,000 total account. And that's not the end of the world, and that should usually be our first priority. Like, oh, if I need the money anyway, I might as well do it. I satisfied my requirement, I used the money I needed. Great, no problem. But you may find yourself one year or another, or every year, like a lot of people do, in a situation where you're saying, I'd rather not take a penny out of this account. Like, I don't need that money right now. I'd rather keep it invested. I'm just being forced to take it out. And the answer is, yeah, you are being forced to take it out. That's them's the rules. How can I do that without paying taxes? Is there any way I can satisfy the IRS without paying the taxes? QCDs, qualified charitable distributions, are the only way to do that. Okay? And any amount that you donate, and I don't care if it's $50 or $100, and we have plenty of people who do that amount. So it's you don't have to peel off, $1,000 or anything. There's no minimum. Well, I should actually double check that. There might be like a $10 or $25 minimum. I'll double check that, but it's very low. Like it's a practical amount. Okay. So you can do that. You can and then whatever you donate satisfies part of your RMD. So let's go back to my real example here. If I have a $100,000 account and I need to take out 4,000, if I donated all four, or not all, forget about the all for a second. If I just donate $4,000 as a qualified charitable distribution, I don't pay any tax on that 4,000, and the IRS says, "Hey, you took out 4,000, we're good. You don't need to take out any more for that year," and then it resets the next year. So I was able to donate, and again, it has to be a donation, but I was able to donate 4,000 pre-tax dollars, dollars that have never been taxed, right? Because maybe you worked for the county, let's say, and you earned that money pre-tax. You stuck it in an account, it grew, it compounded, and now you're donating it pre-tax without being taxed. So that money has never been taxed by the government. Now, again, you have to donate it to the charity to get there. But if you do, let me sum it up for you. I mean, maybe this is the simplest way to think about qualified charitable distributions is if you are RMD age, so 73 or older, and you do any donating to charity, and again, I don't care if it's $100, and if it's more than that, even better. But whatever your amount is, if you do any donating to charity, we should probably be doing it out of your IRA if you have one, or if you have an account that could become an IRA. And again, the reason for that is you get the tax benefit, so you're reducing the amount of income that's being taxed coming out of that account, which you'd have to take anyway. So it's a forced thing that you're reducing the tax on. And you get to take the full standard deduction when you do your taxes. So you kind of get your cake and eat it too. You get a tax benefit for donating to charity, and you get to take the standard deduction when you file your taxes. So you're getting a not just a better benefit, you're getting a plussed up on top of the standard deduction benefit. I'll explain how that works. We'll actually go through some of the tax mechanics here in a second, but that's the reason to do this. Okay? So you don't have to do your full RMD. You can do a portion of it. You can do it throughout the year. You can set it up monthly. You could do it all at once and do it for the full RMD. But it says that last bullet point, it lowers your taxable income. It does. That's technically correct. But what it really does is that money, which otherwise, if you took it out, you'd have to pay tax and would add on to your taxable income, does not show up as income at all for you. It's not even your income because you're sending it out the door. So it's a great strategy if you're already charitably inclined or you want to be, to use that and actually get a tax benefit for it instead of basically, with the way the tax rules are, not getting any benefit for your donations. Again, the most important thing, and I say this to everybody, is get the money where you want it to go, right? That's the most important thing. But if we can do that and benefit you more tax wise, and I mean, even on $4,000, let's say you donated a full 4,000, go back to my example here. And it depends on where your tax bracket is totally. But between state and federal tax on a regular 4,000 versus 4,000 you donate, I mean, we're talking probably close to 30% for a lot of you in taxes, in income taxes that you'd be not having to pay. That's 1,200 bucks on 4,000. So that is, I think well, I don't think I know. That's the main point behind the QCD. But let's talk about a little bit more of the specifics. I mentioned this a little bit. It's got to be an eligible charity. You may have heard of a thing called a donor advised fund. That's a way for you to kind of donate assets into a investment fund that then pays out charities out of its growth, or you can set it up. That doesn't count for this. That's a different thing. If you have questions about that, we can go into it, but you don't get the RMD counting toward the RMD benefit like you do from a direct QCD. You can't get a personal benefit for it. By the way, that also means it's like, okay, so this is a nonprofit, but I'm signing up for their subscription service or whatever. Like you're getting a benefit for it. No, you can't do that. You can't be like actually transacting. It has to be a donation. Now, I know like PBS in the Twin Cities, like if you donate something, they might give you a tote bag or whatever. That's okay. It's the stuff where you're actually getting or receiving a benefit that you know in advance. Like it is a transaction, not just a donation. Um, so keep that in mind. Even if they are a nonprofit, they qualify as an eligible donation. And you can't take it personally first. I can't send you a check made out to you, you deposit it, then you wire the money somewhere else. The check's got to be made out to the organization. That is something we do for you if you work with us, for example. So not that you have to do any of that work, but that those are the rules.
Anthony, just before we get too far ahead, there's a quick question in the
Oh yeah.
Q&A, just confirming it says, essentially, if you give RMDs to charity, you will not be taxed.
Thank you, Aaron. Yes, I missed that, but thank you for pointing that out. Yes, that is exactly right. So let me restate it. I know you just said it there, but the question was, so essentially, if you give your RMD to charity, you will not be taxed on it. That is exactly right. If you give your RMD to charity, you will not be taxed on it. And that is the power of it, because otherwise you will, that's the only way to not be taxed on it. And I would, again, add on the fact that if you give part of your RMD to charity, that part will not be taxed. So it doesn't have to be this all or nothing thing. That's another key point. So thank you, Aaron. Um, so in normal circumstances, I've kind of hit on this already, but IRA withdrawals are taxable. They're taxed as income. They not only affect your income taxes, obviously, but they could also affect your Medicare costs. Because remember, income factors into Medicare costs. This helps to avoid that. And in other words, you only get the regular deduction if you end up itemizing, which fewer and fewer people are. I've kind of said this slide already, so I jumped the gun on that one, but it was I'm glad I covered it earlier. So the income when you donate it goes directly to the charity. We've covered that. It never hits your income. This is the key point. It's a nuanced thing to understand, but it is not a credit or a deduction that you get. The money never hits your taxable income in the first place. And that is the power of it. So again, if I have a $4,000 RMD and well, let's just say I donate all of it, that 4,000 does not show up in my income for that year because it didn't go to me. It went to a charity. And you can still take the standard deduction. The big key here is you get your cake and you eat it too. In other words, I get the big standard deduction and I get a benefit for donating to charity. Um, it lowers your gross income, which is what matters for Medicare. So it's powerful that way too. So let me give you a concrete example of that because I'm throwing a lot of concepts out, which I don't like doing because it can get muddy. So let's say your RMD for the year, whatever the number is, I'll use my 4,000 as the example, but again, it's going to be individual to you. Whatever that number is, when we take a look at your taxes and where your other income sits for the year, maybe you have a pension and Social Security, we add that up and we say, If we take out that full RMD, like we're supposed to, like we have to, you are going to get bumped up into the next bracket for Medicare costs 2 years from now. And very briefly, because this could be its own hour, um, Medicare for your premium cost looks at your gross income from 2 years ago. So if you're on Medicare right now, your premiums in 2026 are in part determined by your income from 2024. And that income then, if you go above a certain threshold, and for like a married couple right now, it's like I think it's like 216,000 of gross income and cut that in half if you're single, so about 108. So you may not be there anyway, but let's say that this extra 4,000 was actually going to be the difference in putting you over that edge if you just took it as a regular distribution. And the Medicare stuff is really kind of punitive because if you go over $1 of that threshold, you get the new premium. By the way, the premium for going one step above the baseline is $80 roughly per person per month. It's actually a little more than that. That's just the Part B part, but $80 per person per month. Let's just use that number. Is that going to make or break any of you on this call? Probably not. Is that money that you could have done something else with that now you're just having to pay for no better insurance, by the way? You don't get a better policy. You just have to pay more for it because your income was higher. That's if we can avoid that, that would be great. So if we would determine, and again, hypothetical, but this is a real world example. If we determine, hey, if you take your full RMD, your premium for Medicare is going to go up next year by $80 a month. And so you're really being taxed even extra more than the income tax. Because don't forget, still got to pay the income tax too. What if we donate 1,000 of it to charity? That'll reduce the amount of your R&D that's taxable, and then it actually keeps you under that Medicare threshold. So that would save you potentially over $1,000 a year by doing that, if that was the exact scenario you were in. So this can be a really powerful tool. Not just the fact that whatever you donate, you don't have to pay taxes on itself, but it could keep you under a threshold that would cost you more just from the mere fact of having more income. Whether that's a income tax bracket, whether that's I could give you a bunch of complicated examples of, oh, if we got right under a threshold, it would save you this much. But suffice it to say, that's something we should be looking at, and we can look at that for you. So that's what I mean when I say it's not just about getting the donation out tax free. It's about you can actually reduce your other taxes because potentially you're not going over some threshold there, especially the Medicare ones, because that's really punitive. You go $1 over, you get the new premium. So it's really a good one to not get wrong. Income tax, not to make this a whole tax digression. Um, but income tax, you go over the next bracket by $1. Well, it's only that $1 that gets taxed at the higher rate. So that's not that big of a deal. You'd still rather not do it, but it's not the end of the world. But the Medicare one, you go over by $1, you get the new premium amount. And again, they don't give you any better coverage for it. You just pay more. So we want to avoid it if we can. Um, all right. So combining your qualified, here's the acronyms again. I apologize. That's just the world we live in. Combining your qualified charitable distributions with your required minimum distribution strategy can help you meet your RMD requirements while minimizing your taxable income. Satisfy your RMD without the tax hit. That's it in a nutshell. That question got it exactly right. You can do this every year. That threshold resets every year. You can do it ad hoc throughout the year, or you can do it on a regular basis. We have people who say, I want to give $100 to my church every month. It's great. We'll set it up on an ongoing basis. No, I only, I wait for when they do a big drive every year, like give to the max or whatever. Great. We'll do that. That's totally fine. It's up to you how you do it. This is something I haven't said yet. All the IRS cares about in regard to your RMD period is that the right amount of money comes out of the account by the end of the year. Let me say that again. With an RMD, required minimum distribution, the only thing the IRS cares about is that the right amount of money comes out of the account by the end of the year. If you take it for yourself, you'll end up paying taxes when you file. That'll be calculated in. If you donate it, you won't end up paying taxes. And if it's a mix, it's a mix, right? So that again is the concept in a nutshell. Let me go through. This is maybe where it gets slightly more complicated. And I don't like that this is the way they do it, but this is super important for all of you to know. Maybe the most important thing from today is the concept. What is a qualified charitable distribution? Why is it important? What does it do? We've covered a lot of that already. This is probably the second most important thing, which is when you do your taxes, how do you do it to show that you did this, that you get credit for it? And it's weird and it's kind of tricky, and I'll explain why. But this trips people up the first year that it happens. And I don't know why the IRS has decided that this is a good way for you to report it, but they have, and that's what it'll feel weird. But so let me go through it. When you take any money out of an IRA, you will get a 1099-R. The R stands for retirement because it's a retirement account at the end of the year. If you've already taken money out, you should be familiar. If you haven't, eventually, if not sooner than your RMD, but at least at your RMD age, you will get one of these. And all it is it's a form that says, here's how much you took out, here's how much you withheld for federal and state taxes. And you plug that right into your 1040 if you do it yourself for taxes, or your TurboTax, or your tax preparer plugs it right in. Very simple. Here's how much I took out. Here's how much I withheld for federal. Here's how much I withheld for state. If you donate to charity, your 1099 will report the entire amount you took out, including the charitable amount, on the same line. It will total it up. And your first instinct, and totally reasonably, is going to say, you screwed this up, Anthony. Why doesn't it have a separate column for what I donated to charity versus what's taxable? And the answer is, actually, we didn't screw it up. That's the way it works. So we need to have a record. We keep this for you, but certainly I encourage anybody to keep records of what the total amount that came out was and what amount of that total is charitable. Because your 1099, this is the point, is not going to break that out for you. Okay, let me say that again. Your 1099, which reports what you took out and what you withheld, is not going to have a separate line on it that says, and here's how much you donated to charity. It would be great if it did. That would be a change I would make if I was in charge of this. That would have been done yesterday. It doesn't. We don't need to get into my theory. It's a little bit of a pet peeve that they don't do that, but I'm not in control of it. I think the reason why this system is a little clunky there is because these just weren't as popular prior to 2017 because more people were itemizing. So those changes, the policy and the reporting hasn't caught up to the fact that these have become so much more popular with the tax changes. Anyway, you're going to look at it, you're going to say, I donated $1,000 of this 4,000 to charity, Anthony, but it says I took out 4,000. So this is screwed up, right? And I'm going to say, it looks like that, but it's actually not. And here's how you do it, okay? On a tax form, and I realize maybe there's somebody on here who actually fills out a tax form by hand. I certainly don't. So, and my guess is none of you do, but maybe there is, and more power to you. But on a 1040 tax return, which even if you use TurboTax, it all gets put onto a 1040. That's the tax form. There is a line that will say, what is your total IRA distribution from this tax year? And so if you were filling it out for this tax season, it would have been from 2025. That is line 4A. That is the line you put in the total amount. So both the amount you took for yourself and the charitable. Again, let's use my example. If my RMD was 4,000 and that's all I took out, because I could have taken out 10,000 even if my requirement was only 4. But let's say I only took out 4. That was my requirement. I would put on that line 4,000. Even if I donated 1,000 of it to charity, I'd put on line 4A 4,000. Because that's the part that tells the IRS I took out the right amount. Forget about where it went for a second. I took out the right amount. Then there's a line 4B. And I'm sorry to be getting this granular, but genuinely, this does trip people up. And I've actually had a few people who their tax preparer didn't do this right and they had to file an amended to get the benefit from it, which I definitely want to avoid. But it's all about communicating it. So on line 4A, you put the total amount. On line 4B, you put the amount that is taxable. In other words, you take the total minus the charitable donations and put the remainder on line 4B. My example, the total is 4,000. I donated 1,000. So 3,000 is what goes on line 4B. And what you are probably thinking is, how do they know? Couldn't I just make that number up? What if I said zero? What if I just said, nah, none of this was taxable? Take my word for it. And technically, I mean, you shouldn't do that because that would be wrong and tax fraud, essentially. But they are basically doing it on the honor system here. Now, I'll explain why there will be a way that they will find out if you lie about it. So don't do that. But when you file your taxes, you're essentially self-reporting here. And it feels weird that our tax system should just rely on, like, well, I guess I'm going to tell you the right number, but what if I didn't? But that is how it works in a lot of cases. So that's a place that trips people up. Now, when you write in on line 4B, I don't believe you have to do this. I'm not an accountant. I should say that up front, but I'm not. But it's helpful. You can write, why is line 4A different from 4B? Write QCD next to 4B. And then they'll be like, oh, yeah, okay. So they donated to charity for some of this. But you are self-reporting it. Okay. And what that means then is that only the amount from line 4B is what gets added to your taxable income. So that's how it actually mechanically works on a tax return. If you use the next page, I was going to get into tax software for a second. No, I'm not going to demo this for you. I don't want to bore you with that. But the key here is unless you report that lower number on line 4B, the minus the charitable, the IRS is not just going to assume that you donated charity. They're going to take the full amount as taxable, and it's going to be wrong then. So we need to exclude the qualified charitable distribution amount from the total distribution amount. You subtract it out, that's what goes on line 4B. When you go on to tax software, they're probably going to just ask you to type in your 1099 information. What was on this line, what was on this line, what was on this line. Most of the tax software out there is then at some point going to prompt you and say, was any of this distribution charitable? Okay. That's where you're going to say, yes, it was. And you enter the amount and then it's going to fill it in for you. So it's not like this is hard to do, but just don't forget that step. Don't forget, oh yeah, that's right. Some of it was charitable. I should have checked that button. Because if you don't tell them, they don't know. And the same is true for your tax preparer, by the way. If you don't tell, if you just hand them your 1099 and say, here it is, you figure it out, they may not know unless they're on the same page with you about what donations you did that you donated some of this to charity. They need to know that so they can file properly for you. Documentation requirements. So the next question should be, okay, well, how does the IRS eventually know that I gave the right amount? And the answer ultimately is there is a form that they will get in May that has information about it. Why May? Because it's after technically you can do like contributions or distributions with an IRA for the previous year up till April, so they have to wait till May to send it out, blah, 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 blah. It's after tax season that this form comes out. So it's not going to be helpful for when you do your taxes. That's why I kind of tell people don't even worry about it. So they will get a form that will have this, but we need to be keeping records on this. I mean, the IRS says that you should be keeping the written acknowledgement that a charity will send you that you donated. We have found anecdotally that sometimes the charities aren't sending these receipts back. They're technically required to, but we've had examples where they've been like, "Hey, we donated to you. Did you send the receipt?" And they're like, "Oh no, we didn't do it. We'll do it now." Like we've had people look into it. I can't speak to that. That's their issue, I guess. But it's possible they're pretty good at it, and the mainstream ones are going to be good at it. And the money you send out is going to have your info on it, so it's going to be tagged to you on their books. They're going to know where to send it. Like it's not going to look like an anonymous donation or anything. But we've had instances where the charity hasn't sent a receipt. Technically, they're supposed to. Technically, that's what you're supposed to keep. If there was the thing to put you at ease is if there was ever a question of the IRS saying or anybody saying, where did that money go? You got a receipt to prove that in case we come knocking and asking you about it. If you work with us, we have a log for you. This amount was sent out to this charity on this date, and we can even confirm that the check was cashed. So it's like, I claimed this, but I don't know if they actually cashed the check or not. What if the mailing address was wrong? Um, we can confirm that the money actually was cashed. So we do have that for you. I've never, in the years since 2017, when this became popular, never once had anyone have any questions about this from the IRS. I'm not saying that's impossible. I'm sure they do occasionally, but this is a popular enough thing that they get it. When your line 4A is different from your line 4B, they're going to understand what's going on there. Okay. Especially if you write QCD in the margin right there. Or again, your tax software will do that for you. You won't have to like print it out and then manually write it and then send it in like that. They'll do that for you. So it's important to keep the record of it. You're technically supposed to, but we have those records too. So anything you get sent back, like a receipt or a thank you, stick that in a folder. Stick or scan it and stick it in a file on your computer. That's technically what you're supposed to do from the IRS. But we have the backup records where if anybody had a question, we could prove, no, this is where the money went. So it feels weird when you're self-reporting. You're like, well, what if they audit me because of this? And first of all, again, we've never had anybody we work with, and we do lots of these, audited because of it, at least to my knowledge. And even if they did, we've got a very clear chain of custody of that money, so we could prove it. So it's a very common thing, but I totally, oh, what should I say? I totally disagree with the way that the reporting for it works. Unfortunately, that's the IRS's deal, not my deal. I have a list, as you've heard, if you come to these events, of like things that bother me that are weird, specific things that like only somebody who does this job would care about. But I have like a list of 15 and like 10 of them are with the IRS. That probably doesn't surprise you, but whatever. It is what it is, but you still get the benefit for it. So the end result is good. I just wish it was a little bit more transparent. Anyway, um, so you need to have documentation, but you don't have to send in like those receipts or those confirmations with your taxes. Okay, it's just like when you save your receipts for itemization, if you were to itemize or when you did, you don't have to send in all your receipts to the IRS. You just have to have them in case they come knocking and ask you to prove it, essentially. Same deal. It's very similar to itemizing in that way, where if you remember, like if even if you haven't itemized for years, when you itemize, you're kind of doing it on the honor system, right? That's obviously where some people, hopefully nobody on this call, but some people have fudged numbers, right? And then the IRS says, that doesn't look quite right. Like you really spent that much on, business expenses or whatever. We don't need to go down that road. But then they come calling and saying, hey, prove it. Prove that what that number you put in is right. It's the same kind of a principle. I wish they didn't do it on the honor system, but they do. They wouldn't call it the honor system, but that's to me, that's what it is. All right. Um, you cannot also here's the key point. Now, this wouldn't really benefit you because you get the same deduction either way. But if you do itemize, you can't claim a QCD as an itemization. So if you do already itemize, you may not want to do a QCD. You may, because if you itemize, you actually do get the benefit from just writing a check to a place out of your bank account for taxes. And it's the same amount of benefit. You get the same amount of taxes off. So if you are itemizing, you may not want to do this. Why this has become popular again is because statistically speaking, I'm confident in saying most of you on this call are not itemizing. Some of you might be, but you might not the next year. Some of you might be itemizing, but your kids are probably too young. That's a bad example. Your parents may not be itemizing. So that's why this concept is important. And again, can't reiterate this enough. It has to go directly to a charity. We take care of that for you. So that's never an issue with us. But if you're like doing this yourself, that's a very key step. Do not just take money out of the account into your personal bank account and then write a check. That won't count. You won't get the tax benefit. And if you claim it and they did ask a question, you would be in the wrong and you'd have to pay the taxes you should have paid in the first place. Um, all right. So none of us on this call, you all have access to us as a resource. Nobody should be reporting this incorrectly, but please ask questions, especially if you do your own taxes, which more power to you. I don't have any problem with that. But if you do your own taxes, feel free to get with us and say, I just want to make sure I'm doing this right. You know, TurboTax or whatever prompted me for this. And I'll say, all right, I'm not an accountant, but that does sound like you're in the right spot. Like I can give you at least a little bit of that feedback of, did you remember to report that it was charitable? Great. That's what you needed to do. Remember to communicate it to your tax preparer. That's incredibly important. If you don't tell them that you donated to charity, and hopefully they ask, hopefully they're sending, and a lot of the tax preparers these days are sending out like a questionnaire that's like 30 pages. Um, and they're asking you all those weird little questions to catch this stuff. But if they're not, or if you forgot to fill it out, make sure they know. And then they're immediately going to say, "Oh, you did. Okay, how much did you?" And then if you need that number from us, we can provide it to you. It's very very simple for us to look up. We have the logs of all of it. And if you want a printout of your logs for your records, that's fine. You don't really need the printout from us. That's not what you're required to keep, but we'll have it. So if you want it, you can, just let us know. But if you do it wrong, you're going to get taxed on the thing that you were trying not to get taxed on. So that's why it's important to do it right. That's probably obvious, like report this correctly, but I wanted to go through it a little bit because it is a weird little process, especially the first time you do it. Okay, so let me wrap up here with one main thought, which is if you are 73 or older, or you're coming up on that, right? If you're 60 right now, this is just a good thing to know. And maybe it affects your parents or somebody you do know that's older. But you've got a ways before you can even do it. But if you're, especially if you're 73 and older, because that's the RMD age, we should be considering whether you should do this. And you have pre-tax money. And I don't care if that pre-tax money right now is in an old 401k or your deferred comp or even an IRA, because those other things can be moved to an IRA. We should be considering this. And the way I put it to everybody, to put a wrapper on it, is if you donate to charity and you're 73 or older, you almost certainly should be doing it out of your IRA. Or if you don't have an IRA, turning your pre-tax into an IRA and then doing it. It's almost certainly going to save you taxes. Now, I say almost, there's people may vary. Maybe I shouldn't be that certain about it, but you should at least consider it. Everybody who's in that category should be considering it. If you're younger than that, then it's just something to keep in mind, and maybe we can develop a strategy where you can manage your donations you want to do before you turn 73 and then after, and do it in the most tax efficient way possible. But this is an incredibly important concept that people need to get to take advantage of. The other thing I'll say, then I will wrap up, I promise, is organizations. If you work with a charitable organization, again, most of the even super local ones are registered as nonprofits. They need to be for their tax status. So they would be eligible for this. It has become incredibly popular for them to put on their own events to bring in their donors or their volunteers and say, "Hey, did you guys know that you can do this from your retirement accounts?" Like I've seen a lot of organizations put this on. Religious, non-religious, doesn't matter. They'll do seminars for their especially retired population and say, "Did you know you can give us money right out of your IRA?" And a lot of people are saying, "Oh, that's interesting. I didn't know that." And so spread the word about this is my point. If you work with a charitable organization and you've got people who fall into that age bracket, even if you yourself don't, get the word out about it. And if they need somebody to go over the basics, one, there will be a replay of this event. So this would be a great resource. It'll be on our YouTube channel. You'll get one for attending in an email. Or feel free to have them call us. I'm happy to walk somebody through. Oh, okay. So you heard about this. You work with the food shelf, whatever, and you've got an IRA. Okay, well let me ask you a few questions. Let me see what sort of benefit this might be able to give you. But I am happy to explain it to people. So just it allows you to be charitable. I mean, I know I talked a lot about the dollars and cents of this stuff, but the ultimate benefit is you get to be charitable. In fact, you might even be able to donate a little more than you normally would, because let's say you donate $1,000 a year, and I'm sorry to be hung up on that number. That doesn't mean if you donate less than that that you're doing something wrong. That number is specific to you, but it's just a round number. If you donate $1,000 a year the normal way, the old way, I'm writing a check, it's coming out of my bank account, I'm giving cash at a drive, whatever. Those are dollars that you had to pay tax on to get them into your bank account, one way or another. Maybe you earned it from your job way back when you were still working. Maybe you took it out of your retirement account, paid tax on it, and then it ended up in your bank, and you just can write a check on it now. And that's super convenient. And I'm not saying necessarily don't do that. But if you are doing that, you're gifting after tax money, and then you get a tax deduction this year that hopefully offsets it. But if you take the standard, you don't even get that. If you gift directly from your IRA through a QCD, you are gifting money that has never been taxed. So, in other words, if I'm gifting 800 normally, I might be able to gift 1,000 because it's actually the same amount, just it's the pre-tax amount. You get what I mean? Like if I took out $1,000, I'd end up with 800 or 700 some odd dollars to donate. If I sent it directly to the charity, I get to donate the full thousand. So you actually get to donate maybe even a little more than you were going to. So it helps the organization more too. So I'll get off. You've been very patient as I've explained this specific thing for 50 minutes now. Hopefully your eyes aren't glazed over, but I try to get to all the little nooks and crannies of this because I think once you get it, once you hear it, you're like, oh yeah, that makes a ton of sense. And it does. That's why it's become more popular. So any other questions I can help anybody with on this, or certainly we can follow up one-on-one. And if we haven't talked about this, I do try to bring it up to everybody, certainly who's eligible. Um, but if we haven't talked about this, it's a great thing for us to get on the horn and just talk through for a second. Oh, tell me about your taxes. Tell me about your donations. Yeah, I do think there's a fit. Or, okay, this is pretty marginal. But very happy to help you or anybody you know work through that just so they can get the money where they want it to go. I mean, that's ultimately it's sending money to where you want it to go. So thank you, everyone. Thank you for putting up with maybe it. Hopefully, it wasn't too jargon heavy. I tried my best. But if you have any questions, I'll hang out for a few minutes here. Just a little promo that for those of you who worked for Hennepin County, which is not going to be all of you on this call, but some of you, and if you still have an account with the county, an old Voya account, we're actually doing an event on the transition over to nationwide. If you don't have an account with the county, Hennepin County, or you don't know what I'm talking about, don't worry, it's not for you. But we're doing a special one on that transition. You'll get more info about it in your mail. I don't know, Aaron, you might even have the stuff ready for that. But you watch out for it because that's a transition. Thank you, I'm reading the chat now. Thank you for the congratulations. I appreciate that. And yes, call us if you need to make adjustments or you want to do something. We set it all up for you. And Aaron, thank you for posting the events page. All right. Well, I'll give it one more minute in case you're in the middle of typing out a question. But if not, I hope you have a wonderful rest of your week, one more day, and then the weekend. And we'll see you again very soon.